Not too loud, not too soft. That's the key. Good. All right. Thanks, Bill. Good morning. Happy. What a great weekend, right? I hope everyone took advantage of it. It's like after the holidays. This Martin Luther King comes, obviously civil rights, and it's an important holiday for that movement. But more importantly, or less importantly, shall I say, it really is a good time to sit back and kind of take in after the holidays, as well as reflect what we want to start for the new year. Great time. So last week we had a hard balancing act between, of course, our mentoring group, which I got to say was one of the, if not from my perspective, from a teaching perspective, one of the best mentoring sessions we've ever had. I mean, I got to tell you, you couldn't have said something is going to happen and teach it and then watch it happen unfold live. It really, questions that were about to be asked were answered in like just exactly the content that it should be for directional option trading. So it was a very, very awesome week in that regard. We, in fact, shared a bunch of things that we found. One was the Priceline weekly option, which I'm not sure anyone caught that. I think Dave Patterson did, an option that was on, was that Monday. We looked at Priceline with the open interest of like 300 or 500 off memory and the volume of 1,700. It was as if someone was overnight trading, day trading Priceline. Well, those options went from 700 to, I think, the high print on the open, or 10 minutes after the open on Tuesday, they were worth about $2,500. It went from 700 to about 2,500. A manageable trade situation. Wild week in Priceline, fell all the way back to 1023, rallied back up to 1043. Those options were just incredible trading vehicle. And of course, we'll look for more of those opportunities. Next, we also saw as we identified with gold and the market and crude oil, a lot of stuff was happening. Some really neat things from that perspective, in the sense that gold, what we found was, many of you do have the list. I put in the documents tab already. So if you go down to the documents tab, you can upload the 119. Should be able to get that and just open that document. And I'll just make sure it is working. The feature does work, and there it is. So we're going to go through this and some of the things that last week are still very pertinent to this week's trading ideas. Last week we talked about a few bullet points, and one was to look for gold, which could see a 3% upside move to get to monthly pivot resistance. It made a 4-point-something% move. And I think it's important that when I write this stuff up, it's kind of like looking at what did happen in the week and then what kind of changed. So all the stock indices, and I know earlier in the week, I mean, I was getting emails from other professional organizations. I was getting emails from producers at some of the global nations, I guess the world's foremost TV shows, asking what would you do for protection in this downside market. And the irony is that I think a lot of people have run scared in the market, and kind of for good reason, because we haven't really broken out of the trading range. But needless to say, this January break, as I've been stating in last week's comments, was that even though we haven't generated a buy signal, we're still in a weekly sell mode, and daily charts haven't generated that buy signal in any of the top 5 stock indices, but it tells me we're in an indecisive trading range environment, and we were supporting against monthly pivot. And that was the message I even gave when I did the TradeStation dual broadcast. Last week we talked about sectors that may see rotation and sectors to be careful of. In fact, I even said in a bullet point, it was so important, in a bullet point in last week's sheets, I said the OBV indicator was warning of potential bearish divergence in the XLF in the financial sector, and the bank sector ETF, the BKX, lost 4%, and the XLF lost last week 2.61%, whereas the S&Ps were only down 1%, 1.25%. The Russell only lost 0.75%. So if one does not think that the Russell, while it is down, it is from a losing perspective, it's still stronger relative to the other stock indices. So therefore, the small cap is still hanging in there, and ironically, the Russell 2000 is the only sector, as I will share with you right now. It is still, as measured by the IWM, it is the only sector that is still actually in a weekly, it's been in a weekly buy, still remains in a weekly buy, and so therefore I'm still not ruling out, and as you can see, if this was a trading range, if this is a trading range with, apart from these 2 days, 1 day down, 1 day back up, if we X that out, this is the more official trading range. We're actually, look where we are in this trading range, closer to what? The high than we are the low. Closer to the high of the range than we are the low. So if we get an advanced decline and we get a pop, if we get a little volume, seasonals is still on our side, I'd have to say that I'm not all that bearish still unless we get that small cap sector getting it kind of smoked. In relationship to where the stock indices are, if we look at the Qs, the NASDAQ 100, while they did not get to their monthly pivot support, they got to their monthly pivot point. So a couple keen observations here. We still have weekly dojis on most of the major indices to contend with. We haven't broken down beneath the range, so therefore we're still in a trading range. I would say we need to break below, on a closing weekly basis, these areas of what's been identified as support, old highs, new lows, and then the irony is the high on a weekly basis of September really has nothing to do with the quarterly, well, I guess it does. It was the high of that quarter, but this is the quarterly pivot support. It has not been broken or violated. So needless to say, there are important levels that the market, all top stock indices, are respecting. So I think that the takeaway is that if you read through and study and print out this weekly sheet, it does give us some importance to bear in mind. Number one, it gives us a starting point of what sectors to possibly avoid or short, or as well as what sectors to go long. And last week was, identifying XLF, or the financials could be in trouble, and that gold could rally. And it's about exactly what kind of happened. And this isn't a bearish market environment for equities. We're in a trading range. That probably kind of happened as well. So now I'd have to say you can read through this yourself, and I just go back and talk about what is happening. Drug sector last week was up, as was the biotech, but volume was still light, and it's a sector that enters a seasonally weak period of time, and I think we will see some of that sector rotation. Stocks and sectors that were up was XLU, which in an uncertain market environment is a defensive play. Coincidentally, it rose 2.6%. when the financials, XLF, lost 2.61. So what do you think? Possibly there was a little bit of rotation from the financials into the utilities. Financials versus utilities, right? So when I see a sector that's lost that amount and a sector that gains almost the exact amount, it looks like sector rotation out of one into the other. God bless them for buying utility stocks this week or last week, because I don't know if that's going to last very long. All right, the financials probably won't recover until we see more evidence of demand pickup. And what's the demand? And this is where we're going to come back to this paragraph. The housing market, or home builders, as measured by the ETF, the ITB. The ITB is not like the home builders that you see on the media, which they talk about the home builders ETF, which is quoted as the XHB. The XHB, once again, XHB, quotes the peripheral stocks, such as what goes into a house, a paint, furniture, mattresses, insulation companies, things of that nature go into the XHB. I'm talking about the actual companies that build the home. Toll Brothers, D.H. Horton, Lennar, Pulte, those are just to name a few. They got smashed down 5.67% as a sector. It was just ugly. But you and I have a little bit of intel and memory. And the memory is we had a big discussion last September, or excuse me, late July, early August that said home building was multi-single family home dwelling units, apartments. People weren't qualifying for loans to get mortgages. The requirements were a little bit restrictive, and so more people had to go into apartments. I think even the media did a big thing about people aren't interested in buying a home, and I don't think that's true. I think they just couldn't qualify to buy a home. People do not really enjoy a whole lot of apartment dwelling living. You can't throw your party, you can't do that. You kind of got subjected to rules and regulations. So anyway, the more important story, I think, is that if you're in an apartment and you sign a lease in like April, May, June, July, you're not getting out of that lease until a year later. And then you might even have to be in that apartment 2 years. But if you're coming out of an apartment, you're going to probably have saved. And if the requirements change, if they lax the rules, in other words, ease the rules of lending requirements, which has been in the works and did get something has started last month, guess what? People may now be saving more, not spending as much, not buying unnecessary items, which probably relates to why retail sales was lower. Consumers aren't stupid. There's so many sweaters that I can fill a drawer with, so many TVs I can hang on my wall over the last few years. A digital camera from 4 years ago is still valid and still works. It's not like it's old technology. The moral of the story is I think people are more saving for new homes, and that new multifamily home buying spree will start probably in the second half of the year. So I'm looking for another 3 up to 6% pullback in many of these stocks to pick up as a buy, since I am expecting housing demand to pick up at the beginning of the second half of the year or earlier. In any event, for this shortened week, the MLK holiday, we have a light economic calendar, fairly light, with some pretty important. Everything's going to be revolved around housing, housing price index, housing starts, new housing sales. And the biggest thing I think people will probably be watching is consumer confidence in Europe, believe it or not. How do they feel? And well as the European Central Bank, and I'll go through some of those things. But I wanted to also point out that I do see crude oil still in a bottoming process. It's stopped the descent. It hasn't rallied, but it's in a bottoming process. In fact, both the XOP and OIH, as I mentioned last week, rallied sharply off their weekly lows, and both of these sectors themselves formed weekly dojis. From a technical perspective, last week we had 203 stocks in the S&P 500 above their 10-day moving average. We bumped that number to 245. That tells me from an internal advanced decline, you're still less than 50% of stocks above a 10-day moving average, but the number is starting to rise. When in a bullish environment, stocks do not accumulate and start trading above short-term moving averages. They go down. So if the market was really bearish, I think we would see from a week-to-week perspective more stocks beneath a 10-day moving average than above a 10-day moving average. The daily McClellan oscillator was a negative 1 point whatever reading, neutral almost, just slightly negative last week, and it rallied to a positive, not an equal, excuse me. That's a shift. If you look on your keyboard, you'll notice positive is above equal. I failed to hit the positive, the shift button, but it's at a positive 85 reading on the daily. Weekly is now at a positive 48. That's pretty promising. Keep in mind, the daily McClellan oscillator is measured off the NYSE and not, and I repeat, not the S&P 500. The daily McClellan oscillator and weekly, or just simply put, the McClellan oscillator is based off the stocks contained in the NYSE. GLD not only exceeded my 3% move last week, it was up 4-point-something%, but what I see and what we discussed and covered and noticed in our weekly mentoring was that implied volatility had expanded not just in GDX and the GDXJ, which is the miners, but it's at 52-week highs. So this is not a promising situation for option buying. One stock in particular that rallied was Newmont. Didn't quite have a rally significantly, but Newmont Mining's implied volatility was at like 48 with a 52-week high, historic volatility, at like 49. So this is more indicative of expansion of premiums, more, which is a reflection of demand. So now all of a sudden people want to buy options and get long gold, and we're just now ending its seasonally strong period of time, and people are going long. So that's pretty promising for both a short-term pause mode. If we think that the rally will stall and go from a strong trend to consolidation, we wouldn't want to buy puts, but what we may want to be exploring sometime this week towards the end of the week is maybe credit call spreads in some of the individual stocks, as well as some of the sectors like GDX, which is the gold miners, and the junior gold miner index. We'll take a look at that later, okay? Keep in mind the S&P, the Qs, the NICE, and the diamonds, the Dow, are still in a weekly sell mode, but they rallied off that support, their monthly and quarterly supports, and they still have weekly dojis from 2 weeks ago. So last week is 1, this week will be 2, and at the conclusion of next week will be 3 that we could potentially form weekly high close dojis in these stocks and these sectors. The Russell is still in weekly buy mode. Now, to review this sheet with you, stocks to watch. It's not that I got lazy, it's just that all this work is still extremely applicable. Riverbed never really rallied, but it hadn't broken. And so Riverbed Technologies is still in a setup mode. Energy sector, these stocks never generated buy signals yet, but one that we do like significantly out of the whole group because of bullish on-balance volume setup is ConocoPhillips, COP. FLIR, Owens, Illinois, TMUS, IGT, and Boyd are still in play. Next, buying April crude, selling heating oil. That spread's actually working. So is the April cattle, feeder cattle, and the two that I really think will come into play will be currency spreads. As this whole Swiss bank thing kind of unwinds, you notice that sometimes currencies aren't exactly mirrored to what they're supposed to be, but needless to say, we wait for this strategy to set up and it'll be closer towards the end of this week. So I think gold peters out. These will be some pretty decent buys. After all, Canadian dollar, Canada still produces gold too, as well as crude oil. So they're more of a natural commodity producing country, right? Lumber, et cetera, et cetera. Anyway, this today, 10 a.m., housing market index. I think Richard Ploser, I can't remember his name, I just put down a Fed head speaks at 10 a.m. just so that you know. It's not a FOMC meeting. It's not a big thing, but he does speak, and any Fed member that speaks, we want to know what time they speak just in case you decide to get into a day trade. The volatility can pop one way or another and joggle the markets. API, I believe, still comes out after the close today because it's a public. It may be delayed by tomorrow. I didn't double check that. But anyway, housing starts Wednesday. Red Book still comes out. ECB meeting, weekly jobs. Here we have the FHFA House Price Index, PMI, Purchasers Managers Index, Consumer Comfort Index. But here's one I think might be kind of neat. Besides the ECB, the European Central Bank, their announcement is at 7:45. How does the Euro consumer feel? Not just the German, the France, but the Eurozone. How do they feel? That might be important. And then the natural gas inventory report comes out, and a half hour later, I have the petroleum oil inventory report out Thursday. Hasn't really been an effective report over the last few weeks. They discount crude declines. They sell off on inventory build. It just doesn't really affect the market right now as crude under $50, but I figured I'd let you know they did change it. I think this will be a big report. It'll be Thursday night. It'll be China's Purchasers Managers in Manufacturers Index. I think that's going to be a big report. Are they increasing manufacturing? What is going on with the Purchasers Managers Manufacturing Index? That tells the story of not just how China's doing, but if most companies manufacture shoes, Nike, Coach, I mean, even I think Louis Vuitton, a high-end retail purse and shoe and good accessory manufacturer, is making product in China. We want to see if manufacturing's increased that shows more global demand, so watch for for that at 8:45 p.m. It will cause, I think, some royal and rocking in the market. The Euro PMI comes out Friday morning. UK retail sales come out. And then, again, existing home sales and then leading indicators. I don't know if U.S. existing home sales is going to be a big one, to be honest with you. How many people really list their homes and sell it in December? Not many people want to sell a home in December and move before the holidays, but, maybe there was a sale and they have the forward contract in the next 90 days if it's been on the market, so maybe we'll see something out of there. Earnings, the big ones. Well, before the market, you had Coach, Delta Airlines. Let's look at ones that we have after the bell today that really, I think, will cause some insights. Netflix, after the bell today. From a seasonal perspective, this stock has rallied almost every year in the last 9 years, or 8 out of 9 years, excuse me. Netflix has rallied after earnings going into the March expiration. IBM is one that I'm personally curious to see. It's like that John Chambers, and we're going to take a look at that in just a second. And then again, Wednesday, you have a lot of Fifth Third Bank. You have a lot of regional banks. Susquehanna comes out this week. Regions Financial comes out this week. American Express, other financials, large and small. Discover Financial Services. And then the one that's coming out is eBay. So we'll probably, during the week, take a look for volume convergences or volume setups, PPS buy signals, sneaky stuff that we may see accumulation in some of these names. Thursday, like I say, BB&T, H-Band, Key Corp is another, Travelers. All of these are in the financial, either the insurer right there, Altria, Capital One Financial, E-Trade. Many of us may trade through Ameritrade, TD Ameritrade. I think their volumes were up. A lot of option volumes, homes should be up. Stocks volatility has increased, so we should see some good numbers there. I didn't list Interactive Brokers because I was partial to Ameritrade, but I also I noticed that I was joking. That's a joke, but it's just out before the bell. E-Trade comes out on Thursday, just to get a general feeling. These are more general public type trading firms. On Friday, it ain't over, kids. We've got a lot of big names here. Bank of New York Mellon, GE, Honeywell, Kansas City Southern, KMB, that's Kimberly-Clark, McDonald's, for example. So we do have some big names coming out in the S&P 500 that we want to kind of focus in on, and it could be more volume this week picking up in the market as less people, I think technicians will see that Friday, while we were having a group lunch, I'm on the phone, I'm looking at the markets and the ticker tape going by, and I see Home Depot up. I mean, I see a lot of names that were sneakily bid up, and this is around 1 o'clock, 1:30, maybe 2 o'clock Eastern. I said, guys, we got to finish. I got to get back to the office. I think this market's getting ready to pop. And I know that Julianne was there and Arthur was there and we had John Zaz there. You guys remember that. And, it's kind of interesting, but I would like to go back, and I will later this morning, to look at a wedge breakout that occurred in the daily E-mini S&Ps. And in that 2005 3/4, 2005 3/4, that's a big number, had been a big number all week. On a Friday, once it popped through that, it was like a wedge breakout. It was a really good setup. Even though it was late in the day, I understand that, but man, they put on some volume going into the 3-day holiday weekend and squeezed a lot of shorts out of the game. So that was kind of an interesting situation. And of course, for MLK, we had a little bit of volatility on Sunday night. The market went down, and then we walk in the door in 3 minutes. We're going to see the market trading at 2020. So with that said, let me go through some of these names real quick. As we've discussed how to read the weekly sheet, what to kind of plan for the week ahead. I want to take a look at this oil, because this oil tends to bottom out and it kind of rallies. It's in that bottoming from a seasonal perspective. The volume's kind of picking up. We had a doji last week. We haven't seen the typical market pop yet in crude oil, but I think it's coming. Big talk about how weak oil is really now starting to become bad for the economy. I heard reports about how oil is going to affect a company like U.S. Steel, which makes the pipes for oil rigs and oil development and oil production. Well, okay, but U.S. Steel, if we take a look at this stock, it actually tends to peak out this year with crude oil. We could say, well, it didn't fare so well, and it's back to where it started. U.S. Steel and another rival, AK Steel, no offense, we need to see this not be a sector built on oil piping, and we need more infrastructure demand. Rails need to be built, bridges need to be fixed, etc., etc. And that manufacturing is a little bit of a concern if there is, but I'm not going to say, oh, guys, guess what? Because crude oil, maybe there was some impact, but if it's in the news now and it's already declined, I think the news is already built into the stock. It would have been nice to say if crude oil drops, this thing could really plunge. And yet, so I have to be more cautious that we could start to see some construction demand coming into the market and maybe see some choppiness ahead for this sector. So I'm looking more for buying opportunity than I am selling opportunity for this sector, especially as we near moving average crossover and the 2013 lows coming into play. So I just thought I'd whip that one out. When I look at ConocoPhillips COP, I mean, and same type of analysis. I mean, I can't really say, all right, well, the trend is down, but boy, these long shadows and the way the market spikes off the lows and the fact that the sell-off, the overall longer-term sell-off came with no volume. I mean, I've got to say that we start the bottom on or about the 23rd, and folks, that's this week. So shadows don't lie, and I would say a trilogy setup would be something very significant here for us, and then watch your options valuations. But ConocoPhillips, I mean, a breakout or a close above 64.5, right, gives us that daily insight that we're looking for. You can see here, if I take a look at COP, which I wanted to cover, trend's been down on extremely light volume, and that is one of the setups that I love. So anyway, I think this stock has a chance of getting back near term another 10%, which is only a $6 move. It's very capable of seeing that, and it looks still, relative to the whole sector, one of the stocks that has the capacity, of rallying. I do want to track down the IBB, and it's one that I've been talking about for several weeks and saying, hey guys, I think that this sector, by late February, early March, I mean, it still has the potential. It's rallying. It's scary. It goes up with no volume behind it. It's not a matter of if, it's a matter of when, right? Even on a daily basis, all of this rally, and last week we went just closer to these highs. There's no strong daily volume, weekly volume, monthly volume. This is a scary market. The longer it stays up here, the more people get accustomed and accumulating, and more importantly, comfortable that it's going to continue to go up forever, and that's my fear there. I think this is the one sector that gets that sector rotation this year, or at least gets us back in the next 90 days to trend, which could be a big downside move. So let me go over and once again to our day trading page. And as it changes here, we'll get this up for you. It's thinking of doing it. It's trying to do it. It's going to do it eventually. Okay. All right, so I want to go back and tell you on Friday, I have to go back in time. I want to go change this. Maybe I hate changing things because it takes a little bit of time. So Friday, kind of an interesting pattern late Friday afternoon. And, if you don't, I think we all have to kind of recognize from a trader's perspective what really makes things pop, right? And so on Friday in the afternoon, when you get these kind of wedge formations and you get the last conditional change or the swing high, you probe over those 204.5. Remember, 205 3/4. 205 3/4 had been a number all week. Once we kind of got over that 205 3/4, and that, we just absolutely rocked and rolled. And the funny thing is, if we look at measuring objectives, it not only exceeded, but it took out the measuring objective to the upside. One of the other interesting aspects is when we get this wedge and you see the daily OBV or volume going with the market, right? You're seeing a slight hint of, it might be subtle, but overall volume is still making higher lows, and then all of a sudden you get a breakout and volume pushes. So it's not some people, what happens is they're caught short, it's a weekend, or some decide to day trade thinking it can't go any higher, and this thing put the squeeze on it, really put a hurt on a lot of people. If you think about it, everyone was bearish down in the hole. People are kind of like thinking, what should I do? And so that magic number, that should act, I believe, this week. It's going to still add a significant support resistance zone for the market on a weekly basis. Now, let me just change this to a 60-minute chart, and you'll note that 205 or that 205 area, look at what it did when it broke out. It came back to test the point of breakout, and then it's moved up again. So for the next day or two, we take a look at this chart, and we note that we have daily higher lows and higher highs predicted for the S&Ps. So we're gonna, if we are in a trading range, right? No offense, 2030, and I'm gonna change this to a daily chart in just a second. 2030 was a big daily resistance. Actually, it's 2031. It's been on the charts for a while. That whole area there, that little confusion where the market popped off, closed back, popped off, and then finally made its decision to break. Broke out, causing that big surge to the upside, broke down. If you can see here, 2031 really is an area that I'd have to say is going to, from a closing daily perspective, going to have to be the defining action. Until we get on a daily closing basis above that, we have a minor trading range. So my opinion is simply this. This is kind of a setup on a daily, longer-term basis, okay? On a daily, longer-term basis. We have a potential, we have resistance, we get that. We also have a swing high area up here. I know it's 2057, but we need to close above that area, above that downtrend, and I really need to see some upside volume. Otherwise, I think we're just in a trading range, and we might pop here, but I don't think it's going to hold because volume is just too darn light. So I don't know if the market gets up to 2030 area, the first test is going to be the area to sell, but I will tell you this, I ain't buying it, and I'm not going to buy it, the market, until now volume picks up, the index, the stock index, because we can still see that sector rotation grind. I'm not getting incredibly jumping up for joy until we break out above this 2057, that swing high with volume. It's a conditional situation. It's not a technical outlook. It's a conditional situation. I need to see this market prove itself with volume and advanced decline. That's condition. I guess it's considered technical analysis, but technical analysis would be more looking at price-based tools like your, RSI, your MACD, your stochastics, your price-based. I want condition. Did the market rally on strong volume? Did the market have good accumulation with the advanced decline? And that's what we're going to monitor. And unfortunately, we're back to that day in and day out analysis, which I think is important. Since it did help us significantly last year, it's probably going to help us a lot this year. So now for day trading, if we take a look at this, markets, try to get up near that. It's not even near by 7 ticks, but Well, I'll tell you what. MLK Day, the markets were open. They were obviously influenced by the European session, and they've come back to where they a little bit higher than where we were on Friday's session. So quite frankly, I think that this market's going to try to re-challenge this low and maybe get into, from a day trader's perspective, I would like to see how we respond into this zone right in here. And I know that's kind of vague, but I want to see how the market responds to a couple little things. The daily pivot down to the point of the average area of consolidation during the holiday market at 1900 hours. I want to see how the market supports in there. So if we do get a market that jabs down in here, stochastics is a little cycled on the high side, and we get some volume, so that it kind of tells me not to be a buyer here, that's for sure. But if we get down here over time, the first couple hours of trading session, and enough people get bearish, guess what? I'm more of a looking for day trade to the upside. Sells, you can still, I don't know if we'll get it, but, 19 to 22 can be sold for the first couple hours, I think. But watch the support down here between 9 and 08 for 9 and 5. I'm sorry to be so vague, but that's the support somewhere down in here, okay? That concludes today's planning. Oh, one thing I wanted to just point out to you, when I talk about implied volatility, one of the things that I just wanted to make mention is look at the 52-week. Look at this is Newmont Mining. Look at these numbers. They don't look relatively strong, but compared to the 52-week implied volatility, they are excessively high for the next 3 months. Not 3 months, excuse me, up until about March. Doesn't the market seasonally peak out in late January, early February? So I think the market is expecting maybe a little bit more upside in gold, but after that, we'll watch and monitor the gold market. But this is not a buying opportunity based off the 52-week historic and implied volatility. I just wanted to bring that to your attention. With that said, that concludes this Monday's planning and scanning, and we'll keep you posted as always. Thanks a lot. And Julianne and John, it was awesome. It was a great time. And there was just a personality volatility skew 1 of 5 days. Other than that, everything was just awesome, man. And I hope to translate that when we talk more about option directional trades, how you guys can look for opportunity then by looking at our style of analysis, and then turn to the option markets and say, whoa, we just picked something up, because not all software will pick up options unusual activity for every market, right? Especially when you go out to like a whole year in advance. So it is a really neat thing to kind of watch for. So